South Africa has officially entered a technical recession in the second quarter following a 0.7% contraction in GDP, with the first quarter contraction being revised up to 2.6% from 2.2%. The largest negative contributors to growth in this quarter was agriculture, transport and trade, while the largest positive contributions came through from mining, finance, real estate and business services. So how do we begin turning the tide on the current economic trajectory? Martin Ackerman, who's chief economist and advisory partner at Citadel, joins us in studio now with his insights. Thanks so much, Martin, for joining us today. So where Bloomberg consensus was for 0.6% growth in the second quarter, we've got instead growth plunging into negative territory. How much of a surprise was this really, or more a case of unrealistic expectations having been set?
Yeah, I think, the market, now that it's the textbook definition for a recession, I think that's why the markets really overreacted and was quite negative on it. But the reality is, whether it's a small positive, 0.5, 0.6, like the consensus or not, we haven't had growth more than 2% since 2013. And so it implies that we're actually not keeping up with the growth in the population. And to me, that actually implies a different definition for recession, because you're not going to create jobs, you're not going to collect enough taxes, and you're not going to help government to actually get out of the fiscal trap. So yes, the technical definition, we can tick that now. We've got the 2 negative quarters, and that's probably the big concern. But in terms of the structural issues underlying the economy, nothing really changed over the past quarter. And
with that, if you drill down into the pressure points here, we've had agriculture offset the positive growth that we did see come through in the mining sector, which was certainly one encouraging point there, while the secondary sector saw the manufacturing sector dampen performance there. So given the broad-based performances we've seen, how worried are you? Is this reason enough to start panicking?
No, I wouldn't say that. I think, manufacturing basically came in flat, which is a very important sector because that's where we'll create a lot of jobs. That's about 13% of the sector, so it is quite big, it is important. If you look at the top contributors, mining almost 5, construction around about 2, finance 2, electricity 2. So there's a lot of those industries that's doing reasonably well. Now, unfortunately, the agriculture one is a big problem, because you will remember last year we spoke about agriculture growing at 30% plus quarter after quarter after quarter. So we knew that somewhere agriculture is going to hurt us, because that high base effect is now coming into play. So we've seen the big number in the first quarter, now the second quarter. So now the opposite is true, to say, well, this low base effect will probably play out through the course of this year.
Yeah.
So I do think, if we stay on course with the right policy changes, the low agricultural base effect is coming through right now, then we can see some rebound going forward.
I asked the question on whether it's reason enough to panic, because we've got Finance Minister Nene over in Beijing with President Cyril Ramaphosa saying that while it is understandable that there's some panic in the market, he insists that the government has a plan. Are you convinced? Because, as you highlighted, it's those structural weaknesses that need fixing right now.
I think so. I do think that they have a plan. I do think what we've seen to date, they've made some very positive changes from state-owned enterprises, making the right things at the right places, but it will take time. It took us 10 years to get to this point. So the first 2 quarters that we are talking about right now is legacy. That's spillover from 10 years of mismanagement and corruption. So the changes we are making right now, that will take months, if not years, to really show up in the numbers. So we need to be patient, and it's very unfortunate for the new administration that they're almost starting with a recession, but it's definitely not their fault. And I think the only thing maybe where they can fast track is the uncertainty around the land issue and the mining charter, because I do think there's a lot of capital that's currently being held back, and as soon as we've got clarity on that, that will be pumped into the economy, and that will actually support quite a good rebound.
Well, underlining that point is the fact that we've seen gross fixed capital formation growth come in negative at 0.5%, so no new investment is taking place in the economy, and until investors have that certainty you talk about, that's not going to be unlocked. And yet we've got the president on this roadshow targeting 1 trillion rand worth of investment in the local economy. Do you see this scenario starting to hamper what the new administration is looking to achieve from an investment perspective, or are investors forgiving and understanding of the fact that there are a host of legacy issues that South Africa has to contend with?
I do think so. I think investors are still very much positive on South Africa, local and offshore investors. But like I've said, the land issue is a major uncertainty, and the mining issue. So, and the government is working towards giving clarity. So we know the mining charter, it's coming in November. So those things will help a lot with policy certainty. That apart, I do think that the government is, like you said, in China at the moment, trying to find sources, trying to find alternatives. The stimulation package that they're talking about, that's a very good positive. If they target that to the right industries, we can kickstart some of those industries or support those industries going forward. My biggest concern right now is to say, well, will the rating agencies allow us more time for government to actually implement these policies and start showing results? So in February, they basically gave us the benefit of the doubt. We had a number of 1.5% in terms of economic growth. Next month in October, with a medium-term budget, there's no way we can use that number. So, they need to downgrade their forecast as well. And that immediately implies a lot of pressure on your fiscal targets and your debt to GDP. And remember, since February, we had higher than inflation increases for the public sector. We've got the promise of the National Health Insurance and the Cyril Ramaphosa's stimulation program. So to actually get enough funding to provide all of that, that's a major challenge.
Because we've got, at this point in time, as far as monetary policy is concerned, the SARB is sitting with very little in its arsenal. What's your outlook on interest rates, given the fact that we've got this low growth scenario, but that inflationary risk moving higher? Yes, some of the pressure being alleviated by the fact that we're only seeing a 5-cent hike in the petrol price this week, but that can only play out for so long.
No, I fully agree. If you just look at the movement in the rand today and the oil price, there's definitely more petrol increases coming. And my question is, will the government be in a situation with enough reserves to do a similar thing going forward like they did today? I don't think so. So inflation is going to reach the upper end probably going into next year, and that implies that the Reserve Bank is probably not going to be in a position to cut interest rates, which is bad for the consumer because they're already dealing with higher VAT, higher petrol prices, and I think going forward in the next 12 months probably also going to deal with an interest rate increase.
And that reflected in the fact that we've seen household spending post its first decline since the first quarter of 2016. Martin, let's leave it there. Thanks so much for having joined us in studio this evening. Of course, Martin Ackerman is Chief Economist and Advisory Partner at Citadel.